Hello and welcome to this special edition of the Security Token Show. Fortunately, we don't have our usual programming for you this week because of Miami Crypto Week, which happened last week with a ton of crazy programming, including a special event that you get to watch upcoming right after this. But Kyle, I want to know, what did you think about this week's Crypto Week?
It was unbelievable. So great to see a lot of our good friends and partners that just Zoom doesn't do enough justice. We were here in Miami. We've been here for quite a while now, and it was exciting to share what was an unbelievable week with so many great people from all around the world.
Never seen so many crypto people all in our beautiful city in Miami here.
We love it. We love it.
Freaking awesome, I gotta say. In fact, we had the pleasure of working on an event with Securitize that had over 100 people. I could not have seen so many people engaged in security tokens, ready to tokenize the world, ready for the amazing panel talking about the future of investing with digital securities.
So you're going to get to check that out right now. Fortunately, the team at Security Token Market was able to capture the event, capture the rockstar panel with some real great innovators. You're going to be able to check that out in replacement of this week's Security Token Show episode. But you better believe we're coming back at you next week with regular programming.
Absolutely. We'll see you.
Let's get started. We have an all-star panel here today. Super excited to get into it. We've got Jeremy, the CEO of Circle, one of the largest infrastructure companies in the space with USDC, one of the largest stable coins in the entire world. We've got Carlos Domingo, the CEO of Securitize, one of the leading issuance platforms for security tokens and digital securities in the world. We've got Steven, the CEO of Algorand. We're all familiar with one of the largest blockchain protocols for security tokens and other applications. And then finally, we've got Diogo, who's, of course, the president and co-founder of Anchorage, the only digital bank in crypto, as well as many other services such as custody, staking, and otherwise. So we have a great panel today to talk about what is a security token? How do we get into this new form of investment? Why did Carlos and Securitize just launch 2 new tokenized fund products for crypto? I don't know. Let's ask him. Maybe after his drink of water. Why don't you tell us about your latest announcement?
Actually, the idea of launching this came together with Nathan, the CEO of Anchorage. We were talking about how DeFi is exploding, and I had a lot of friends that came to me and said, I was telling you can put money here or there and generate these yields. And they were like, how do you do it? It's like, very easy. You go, you purchase some USDC, you open your MetaMask wallet, you put it here, and they were like, they're lost after like a second, right? So, we had the idea, like, why don't we produce institutional products that behind the scenes, we work together with Anchorage, with Genesis Trading and other liquidity providers to basically do all this crypto magic behind the scenes so people can get exposed to yields through traditional securities in digital format that they can also put in investment retirement accounts, etc. So we launched an asset management company called Securitize Capital with the first 2 products, but the idea is to start launching more and more things to basically make crypto more accessible.
Yeah, that's one of the things we've talked about many times is how do we lead by example and create adoption. So we applaud what you guys are doing. And you've had to assemble an all-star group of partners to make this possible, right? Obviously, you run your own platform. I always encourage people to eat their own dog food in the space. So glad to see you use your own product for your funds here. But at the same time, Jeremy, Circle, USDC is a critical component to this whole operation. People get paid through it. People use it in order to represent a digital dollar, right? So could you maybe talk to our audience a little bit more about how does USDC and Circle operate within this sort of partnership?
Yeah, I mean, at a high level, that's right. I mean, USDC, we think about it as a format for dollars on the internet, as a way to have a protocol for anyone to connect to dollar transactions on the internet. And people a lot of times people ask, what's the use case for USDC? And the answer is, what's the use case for a dollar? And so when you combine the sort of superpowers of the internet, and the fundamental intrinsic characteristics of digital currency with a dollar, that's really, really powerful. And that's what we've been building and doing. And I think with respect to these projects and these initiatives, clearly this shift of capital market functions to on blockchain transactions, whether it's the interest rate markets that we see today or other forms of securities that are going to be issued in a digital asset native way, all of those need to have a stable value dollar digital currency, whether it's putting funds in, getting funds out, having forms of collateral. So just increasingly, we think about the use cases for a far broader range of capital markets products being huge and tremendous opportunity space for things like USDC.
Reasons like that a security token is possible to make it digitally accessible and feasible because you can actually pay on-chain through USDC, which leads to cost efficiencies and many other benefits.
If you just allow me for a second. So if you think about what are the powers of blockchain is that this is the first time that the same ledger represents cash and securities. And one of the inefficiencies in the world of trading is that when I want to sell you a security and you need to send me cash, we need to make sure that there is a double spend problem where I send you the securities, but my cash hasn't arrived, and then you go and sell them to somebody else and stuff like that. That's what Bitcoin solves for as a currency. And then in the world of securities, the fact that we have a stable coin like USDC issued in the same platform with the same format and with the same ledger that you can issue securities and swap them, it actually solves the problem of like having counterparty risk when you're trading, and you need intermediaries and all that stuff that is problematic in traditional finance.
And that makes a lot of sense. In fact, all of it wouldn't be possible without an underlying blockchain protocol to support what's happening here. And so let's hop over to Steven. And why don't you tell everybody here how Algorand is actually making it possible?
Yeah, well, I think if you look at blockchains, and for those of you who don't know, Algorand was designed by Silvio Micali, who's a famous cryptographer. The idea is to be secure, scalable, and decentralized. And I think one of the things we've looked at are ways that you can make it secure not only from the protocol itself, but how you make asset issuance secure and simple. In Algorand, you just post a transaction. It's not a set of smart contracts. Atomic swaps are native. So the idea of exchanging dollars for a security that happens in a single transaction, whether it's many assets and many counterparties or one asset, one counterparty. And I think in addition to the core technology, we've really spent time thinking about what infrastructure is needed on top of the protocol itself, and which is why we are one of the few chains that have USDC natively on chain. We work with Securitize, Anchorage, everybody here, because ultimately all those things are needed in addition to the core technology to be able to both create security tokens and then trade them on chain.
So we've got the blockchain solution that powers it all. We've got the token and issuance manager through Securitize. We've got the stable coin that pays the yield. Obviously, what's missing here is we need a custody provider, and we need the magic of the staking program. So, it's your turn, Diogo. Let's go.
I hope everybody appreciates that I'm missing my own event to be here, so that's actually pretty cool. The Anchorage team is on a boat somewhere, here hanging out with you guys.
Dedication.
How are you going to get to the boat?
I don't know, using another boat. That's probably the Miami way. No, that's. I think it's worth for me to point out one of the things that we found that is particularly interesting lately is we talk about corporate balance sheets and all this like Elon Musk, Tesla, Bitcoin, not Bitcoin, selling, not selling. Anyway, when we started having these conversations with companies and we were talking about this corporate use case of putting Bitcoin and other crypto on their balance sheet, they looked at it and said, okay, this is very interesting. And then we would talk about yield generating in our financing product, and they would point to that and say, hey, but I actually want that. What do they want? They have dollars on bank accounts generating 0% yields on their SVB account, and they want to generate 7 to 9% a year. And that was basically what was happening. The corporate came for Bitcoin, came for Ethereum, and then they immediately became interested in deploying their dollars onto these systems and onto these financing products. And so obviously, to deploy something like this, you need a whole stack. Anchorage is, as mentioned, only federally chartered bank. So we actually have the same regulatory clarity and scrutiny as Bank of America, JP Morgan Chase, BNY Mellon. It's the same exact charter, and we can do obviously custody, but we can generate yield. We're lending out these things. And therefore, people like Securitize can actually build products, really cool funds, building on our APIs, building on our platform, and have everything be regulated end to end. So it's pretty interesting that this is happening.
It's incredible. I hope everyone appreciates just what's really happened here, thanks to Securitize and the partners for changing the dynamic for institutions to be able to access these new types of crypto products. If we had to do this traditionally, we would be having difficulty onboarding investors manually. We would have to do a traditional transfer agent solution, which is slow and outdated. We would have to pay dividends out through bank wires and understanding the Excel sheet of who owns what, right? We wouldn't have a blockchain solution to automate with smart contracts, and we certainly wouldn't have the custody and staking capabilities that are being brought to the table because everything is on-chain. That is the future of finance, and that's what's happening with security tokens. And so let's start getting into some of the hot takes now that we got the good plug out of the way here. Jeremy, you just raised a monster $400+ million round. How much was digital securities part of your pitch? You mentioned earlier that what is the use case for $1? Obviously, finance powers trillions of securities. That has a lot to do with cash transactions. Was this a big part of your pitch?
I mean, look, I think a couple things. I think one is, we believe that the storage and transmission of value is going to be a commodity-free service on the internet, and that just like moving data, moving content, communications, anyone can connect to anyone, anywhere, and do that instantly at the speed of the internet at no cost. So I think one is just generally the superiority of digital currency as a model of money, as it has so many powerful intrinsic characteristics. So one is just, we think that's going to grow. The commercial bank electronic money, which is sort of the traditional forms of electronic money we have today, it's about $130 trillion in the world. We think that digital currency models will take a larger and larger piece of that over the next 5 to 10 years. That represents a really, really extraordinary opportunity. That impacts every form of payment and settlement. But we look at it as like this, there's sort of these different layers, right? We have this base layer of these internet operating systems, like these public blockchains like Algorand, Ethereum, and others that are really competing and innovating at that operating system level. And then you have these financial protocols that are built on top of it. And think about things like USDC, and I think about security token protocols like Securitize is doing. And then you have the regulated financial intermediaries that are actually building entirely on this infrastructure, firms like Circle, firms like Anchorage, and Securitize as well. But I think all of us, at least certainly Circle, we were really inspired back in the origin founding of the company around this idea that you could issue assets on blockchain, and that those assets would become programmable. And what I think animated what we were doing back then was you could issue an asset that represented $1, but you could also issue an asset that represented property or equity or many types of things. And I think many of us were here during the 2017, early crypto cycle. And what's really interesting about it is all of the ideas that were put forward around tokenization, around security tokens, around stable coins, around what blockchain infrastructure could be, they were all true. And every single one of our companies, I think, had a significant kind of set of catalyzing moments during that time to build the intellectual property to actually get us there. That's what we were doing. We were building for the last 3 years, and now it's actually coming alive. And so a lot of those ideas that maybe looked like pie in the sky a few years ago are now happening. And so now this new capital market infrastructure is being born. And I think this tokenization of really, really broad ranges of assets is going to proliferate on a massive scale. It's going to eat more and more into both traditional capital markets, but it's going to allow for novel new forms of issuance. And so yes, to answer your question in a long-winded way, digital asset securities, I think, are a huge use case for USDC. It's a huge use case in what's going to grow and what's going to drive demand. And if there's 130 trillion in M2 money, there's like, I don't know, 250, 300 trillion in equity and debt markets. And so, these are huge markets. These are absolutely huge markets, and the internet is going full force after that in the same way it did other industries. And so I think that's part of kind of the underwriting on our financing.
I think that Jeremy just said something which is very important, right? Like when you digitize things, you obviously eat on the non-digitized part of the business, but you also create new stuff that you couldn't foresee before things get digitized, right? And the simple example to understand this is music, right? So I'm old enough to remember the vinyl LPs where you play analog music. And then in the 80s, Philips and Sony, they invented the compact disc. And the compact disc was digital, but the consumption experience didn't change overnight, right? Because you still have to buy a physical disc, you still have to go to Tower Records or Virgin Megastore or whatever, buy it, and you have few features that were better, like you could jam songs and the quality was slightly better. The form factor was smaller, but nothing substantially changed at the beginning, right? But the fact that it was digital, then it opened up the opportunity for companies like Apple to tell you have rip off the music and put it in this mini hard disk and carry 1,000 songs in your pocket. And then they realized, well, I can actually just download it off the internet. I can buy one song, which sounds stupid today, but it was very revolutionary back then. You don't have to buy the entire album. And then music is streaming and blah, 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 right? In the music industry, it took 30 years to completely transform the consumption experience. So I see capital markets with all this infrastructure we're creating as the same stuff. At the beginning, it's just going to be a better, version of the existing set of things, but then eventually new stuff like, automated market making, price discovery for private securities, stuff that doesn't exist will be created in this new native digital platform over the internet. So that's exactly what I think.
And to be clear in your analogy here, everybody here is trying to build the Apple, not the compact disc. We're getting there.
But these guys are right. So digital, the underlying digital platform, and we build the.
What is that again?
I think that if just to extend on what you guys were saying, we think that public blockchain networks are sort of the next obvious utility. So think about running water, electricity, internet. This is something that just needs to be a public domain. Beyond that, though, if you look at where we are in terms of the cycle, there's, I think, around 50,000 blockchain developers, let's say, give or take 50,000, it doesn't matter. And there's 20 million developers that don't build blockchain, that are largely focused on mobile and web. And so there needs to be much better both developer tools and infrastructure on-chain so that people can very quickly and easily create securities, can create any form of asset they need. And I think one of the things that we believe really strongly in is that as these things form, you'll have capital flowing in toward more traditional assets, maybe security tokens. You'll have capital flowing in from more natively crypto applications. And that one thing that public blockchains can be is really an intersection point between those two. And I think when we get to the next step, past sort of the CD phase of copying what exists traditionally, we'll start to see more sort of interesting hybrid, financial instruments and products that are constructed out of, kind of these pre-existing things.
I think with DeFi, we started to see that, right? Because those are very novel things. Like I talk to people coming from traditional finance. When you tell them, no, you can borrow and, for 30 seconds, $1 million, and then put it as collateral in the place, and then take a yield, and then put it back, and they're like, how is that possible? It's, well, this is software, right? So that's how it happens. So you just write software, and software does these things, and these are new novel financial services, and people just don't get it, right? This is like new rails that are being built parallel to the traditional capital markets to do new stuff.
Yeah, one of the, sorry, go ahead.
I was just going to say, one of the interesting things that started happening that I think is absolutely fascinating, and that really encapsulates everything that we're talking about, and it's happening in 2020, it's happening in 2021, are these companies that are crypto native, but crypto native in the following way. They raise in stable coins, they pay salaries in stable coins, they decide that they want to be a consumer bank, so they offer checking accounts in stable coins. They offer yield savings accounts that allows them to actually do in stable coins. They offer Bitcoin for actually like long-term investment. And they offer Visa credentials that they settle directly natively with Visa without ever touching fiat. So you have a full bank that has never touched fiat in its history, has never engaged with a fiat custodian or a traditional bank. It really is the power of the industry, which is these gatekeepers that were there before that you had to talk to issue a card or to be able to settle or to be able to have an account. They're no longer the people that you talk to. You don't need to talk to them. It could be 100%. The company itself is crypto native. And so all of these things that are happening are gonna, in 2020, I think are gonna explode, and it's fascinating to see that this is happening. And in fact, to the Securitize point, you also can add equities alongside your stable coins and your Bitcoin for long-term investment because they're tokenized. And so it's just a wallet. They do not need to talk to a brokerage, to a traditional brokerage in any way, shape, or form, the same way that they don't need to touch fiat or talk to a traditional bank. This is kind of amazing.
And this is, Jeremy said, these things were dreams when we started in 2017. Like people were talking about these things and they were actually not built. We didn't have the licenses that you need to do it, etc. But the huge difference I've seen the last 4 years is that this is a reality, as Diogo said. This is happening now. It's not science fiction anymore. When I did these panels 4 years ago, we talked about science fiction and a vision of where things were going, and now it's a reality.
I just want to make another point, which is, I think it's really easy when thinking about security tokens or digital asset securities to use the CD analogy and what you gave that analogy, which is to sort of think about like, okay, well, we already have a way to trade stocks. Like, why would a tokenized stock be any better or this or that? And it is, I think, a really limiting view. And I think what makes this so powerful, and you already see this in the DEX space, and you see this in the centralized exchange space, whether it's Binance or FTX or DEXs like Uniswap and SushiSwap, which is that the internet has always been able to build extraordinarily long-tail markets. And long-tail markets is just this idea that you can serve with a multi-sided market on the internet, a platform on the internet, you can service an incredibly long tail of providers or buyers. And so, eBay was the first classic example of that, which was to say, hey, I'm an individual that owns some Beanie Babies. I can sell them. There's a market for that. That didn't really exist. That's the kind of classic example, obviously. But Google AdWords created a long tail marketplace where you had enormous price discovery that allowed an individual, say, sole proprietor that taught something in a neighborhood to find their customers super efficiently. But even General Motors to spend an enormous amount to do that. These multi-sided markets, these long tail markets, the internet does that so extraordinarily well, and I think that's what's exciting about this, that long-tail capital markets can exist. Long-tail capital markets haven't existed before, and I think what is happening with digital asset securities, public chains, the exchange infrastructure, stablecoins, et cetera, they all light up this ability to have long-tail capital markets. And we can't imagine, I think it's hard for us to even imagine what that means, that you'll have a capital market, an exchange market, for millions and millions and millions of securities, potentially hundreds of millions of securities over time. That's going to be feasible, just like you can have hundreds of millions of advertisers or advertisements that efficiently find a market on the internet, or content items that can find people in the right way. And the application of the internet to solve these problems is dramatic, and that's why I think when you look at things like NASDAQ or New York Stock Exchange, they'll look like relics in a matter of years, because this infrastructure is going to be far, far superior in terms of enabling that kind of capital formation and discovery. And if you look at DEXs today, really novel innovations, the ability to create liquidity pools and incentivize liquidity even in highly, highly illiquid assets. People always said private capital, startup equity, these things are hard to trade because they're illiquid, et cetera. You can actually build incentive models and liquidity pool models on these long tail assets that can find market pricing and find discovery and find liquidity and do that efficiently, do it without traditional market intermediaries. And that's to me, that's what's so exciting about this.
Blockchain cutting out the middleman, right? And that's the future I think we're all betting on. Carlos, you were one of the first people to ever even launch, I think, the first ever tokenized fund, right? So you've seen this vision, but we all know that in 2017, there was not the same infrastructure. We want to almost compare it to, is it comparable maybe, Carlos, to the 1990s, where we saw a hype, and then in 2000 we saw a crash, and we saw a resurgence around the technology? Are we past that? Was that 2017 to 2021, or do you think that there's still another wave that we need to get through?
No, look, I think that when we all started here, I approached the problem from a technology perspective, right? I saw that the technology can solve the problem, and I think what I was naive about it is that unfortunately the technology advances faster than regulations. Then you have to eventually play alongside with the regulators to get licenses and stuff like that to be able to do things that you can do with the new technology. And I think that's what happened in 2017, 2018, that kind of hit a wall a little bit, because we had the technology, but not the regulations were not in place, or the regulators were scared about it, or the companies in the space that didn't have the licenses, like Anchorage or us or Circle don't have, etc. I think at this point in time, if you look at it, there's all the licenses that you need to operate legally in a regulated environment with a superior technology to be able to do a lot of things that you cannot do in traditional capital markets. And now what makes me think is that this is what's going to be the main driving factor for adoption the next few years, as opposed to what has happened the last few years, that yes, there's been adoption, but it's been slower than what people expected.
So the infrastructure is there, and you bring up regulation, which is obviously a hot topic. In fact, Diogo, I think all of us want to hear a little bit more about your experience and your viewpoint of regulation and the government. You were one of the people who was able to get the only bank, right? You were talking to now the new CEO of Binance US, but at the time the active OCC, Brian Brooks. So how was that experience?
Audience,
oh, even better, right? So tell us though. We want to know, what was the experience? Do you have the same renewed faith in other government agencies? Do you see regulation catching up? To Carlos's point, are you there, or do you think we still have some ways to go?
The OCC was very forward-looking. They released guidance. They very obviously told the world what they believed the national bank could do in crypto, all of the functionalities, and then obviously we were the first to get the charter. I think part of the reason we were the first is because we did a charter conversion. We're already an operating company. We already had years of track record, and so they were able to see this actually happening in reality. One of the things I'm really proud is, of course, that the charter talks about things like staking. There is a federally chartered bank that says that they have staking as a service. This is absolutely amazing. And of course, it doesn't say other things that we will need for it to say at some point in the future. It doesn't say yield farming yet. And so all of these things, obviously, as was said, are always lagging indicators. And I don't envy the job of a regulator that has to create regulation that has to last, but is somehow trying to catch up to a space that is moving so fast that even the people that are full-time in the industry candidly can't keep up. I can't keep up with every single, I think we have Brad over there in the audience, only the VCs actually know what's happening. And the VCs are deploying, like they're making 6 investments a day. So I don't know that they know that is what's actually happening, because I can't do 6 deals a day and do deep due diligence.
You have a day job as well.
That's right. And so it's very hard to keep track of what's happening. And so if you're a regulator, how are you going to regulate something that hasn't really settled? And I think we have to be candid. The market structure hasn't settled. We don't know what the market structure is for crypto. In the traditional world, we're very familiar with the DTCCs of the world. And in crypto, we understand that the blockchains are actually the actual true settlement layer. But what does that actually mean? What does that mean for the industry? What does it mean for the proliferation of exchanges? What does it mean for cross-margining? Does it mean that there's intermediaries, more intermediaries, less intermediaries? So all these things that are happening are very hard to do. So to answer your question, we continuously are there to educate. We're constantly pushing the envelope. I think it's a major win for the OCC charter and for these things to be, black on white, and to be an actual federal bank that can do these services. And I think we're seeing some of these products coming out that are benefiting from this. They're benefiting from these kinds of obvious qualified custodians in the market itself. So we're never going to be there, is what I'm trying to say. We're always going to be innovating faster than what the regulation can actually do.
But look, I mean, there's 2 ways you can play on this, right? You can just try to fight the regulator and ask them to change things, or try to adapt to some things and then move on until they change. Like I'll just give you an example. When we got our first registration with the SEC as a transfer agent, one of the things they ask you, the regulator, to do is you have to fingerprint the people that touches the certificates of the securities of the shares. And we went to the SEC, it's like, we don't have physical certificates, we're just doing it on the blockchain, they're digital. And they're like, so fingerprint somebody, and they will fingerprint all the developers, and people had access to and then we submitted a bunch of fingerprints, and then we got the license, so.
Disrupt, not destroy. Very important motto when it comes
otherwise, I'll
to
be sitting here without my license, right? So, no.
You also have to be strategic about which conversations you bring up. We're getting
Pick
there.
your battles.
Once you bring liquidity pools and bonding curves of automatic market makers,
it's a disaster.
And then they ask you, do you know who's on the other side? I was like, no. You know that they're on the OFAC list? No. And then all of a sudden, it just devolves from there. And so those conversations are to be had maybe at a later date.
I think, though, irrespective of the regulation, if you look at where we are today versus where we were even a couple of years ago, the fact is securities are getting issued every day through Securitize. On-chain, we're seeing, you guys are a, chartered bank. I think, the tools that are needed to bring business, faster and faster and bring some of the, volume of assets that Jeremy was describing onto public blockchains, very quickly. I feel like those pieces are in place. It doesn't really matter, I think, in large measure whether, by the way, I don't think the internet exactly repeats itself here in terms of dates and stuff. I know it's a good way of talking about it. I think what we are seeing is we've reached a place where people are building scale businesses, and there's a lot being deployed all the time, and that's a very different dynamic than it was in 2017.
Yeah, so think about it for the regulators. I was talking to a very large asset management company today, and they were saying, what do you issue on the blockchain and not on a normal database? And I was like, well, if you're doing a normal database, there is no guarantee that you're not rigging the system, right? Maybe your board has authorized to issue 1 million shares. Somebody goes and sells another 10,000. Nobody knows, right? So you sign papers on the side, and then suddenly there's more shares than have been authorized issued for a company. If you use a token on the blockchain, there's traceability, immutability that to actually control that, that asset only exists in the amount that has been authorized, by the company, right? Because if you issue the 1 million one, you're going to see that there's 1 million one tokens, and there's no way to delete it or for somebody to manipulate it. So it's just a better ledger for representing ownership in a programmable way. That's what it is.
Let's talk about the ledger technology and go back to Steven here. You chose Algorand out of the many options. For those of you who don't know, by the way, I run the advisory arm, Security Token Advisors of Security Token Group. So we have a lot of clients who have been flocking over to your protocol. And originally, Ethereum was the go-to choice. Obviously, rising transaction fees adds to this. But you mentioned earlier focus on development tools and capability. Why are people rushing over to you to launch STOs? And I'm sure many of us in the room are thinking about tokenizing. Why use Algorand?
Yeah, well, I think there's a few different things. And I think transaction fees are certainly one particular problem right now. That probably won't be permanent. I do think that if you look at the way transaction fees in Ethereum are being addressed, it's by having many different parallel chains and shards, and we think that that's certainly will gain some momentum as a short-term solution. We think when you look at complex financial instruments and complex financial instruments being traded, you need a composable layer one solution. You need to understand kind of what's going on across the different assets before you can transact around them. So that's why we feel really strongly that not only do you need sort of a fundamental, scalable, inexpensive, effectively free, secure and decentralized platform, but you also need the primitives that allow you to transact, and it needs to be one layer one, not shards of them, because you need to understand, if you're going to transact $1 billion in one shot, you don't want to do that if the other side has just traded away some of what it had. And so I think that reconciliation just needs to be avoided. So I think that's one of the pieces. I think the second area that is not very well understood is auditing of smart contracts is becoming a massive problem in the market right now. And this is sort of a follow-on to the developer tools. Right now, if you're a small project, it could take several $100,000 and several months to get your smart contracts audited. And God forbid there's any problems you have to address. And that's, there's just not enough people who can do that manually. And we saw this in the early days of the internet where, for a while, you had to hire a $100,000 a year system administrator. Today it'd be much more for every 15, 20 servers that you deployed. And so I think we're sort of at that point now where there's a lot of manual intervention. And so one of the things we look at is, ways to create primitives in the blockchain that reduce the need and scope for smart contracts so that now it's just part of layer one and you get the security of layer one without having to do anything more than understand how to use the chain. And then the second is using decidable languages. Like we have a partnership with Blockstack for clarity. We work with another project, Reach, which has a restricted version of JavaScript where they actually generate formal verification proofs. And so I think when you look at it, these things need to be automated as well. And so definitely it's an area we've spent a lot of time thinking about. And I think that that's going to become more and more of an issue as there's more developers.
Look, if the vision of this being a public utility that addresses the long-term market that Jamie was saying is the right one, which I believe is the right one, that needs to be very cheap, because if the internet wasn't very cheap and very accessible, it would not have taken off, right? So, and the same thing with electricity and the same thing with water and other utilities. So eventually, either these things become extremely cheap and then people get compensated because of a huge volume and new stuff coming in, or it's not going to take off.
I think that makes sense. I know that we are planning to have a little time for Q&A. You guys probably have better questions than I do. But real quick, since we have them on the spot, let's see what we can get out of them. We're going to go down the line and see if anyone wants to tell us anything that we haven't read about, something big coming up. Come on, tease us with something, or at least leave us with some good 2 cents before we move over to the Q&A. Jeremy, why don't you kick us off?
Yeah, sure. So, I mean, this relates to some of the earlier stuff as well. We're just really excited about helping more corporations to use USDC as a treasury infrastructure. And I think, what's happening with USDC in particular in borrow and lending markets, in DeFi and CeFi is really significant. So we have a wait list now on a product which will be introduced soon, which is a high yield account for your average business to be able to very easily open an account, move capital into USDC and access fixed term, fixed rate, USDC yield. We think ultimately, every business in the world is going to have an internet native type of financial account, and there'll be a range of things that they can do. But this new product that we're introducing is one we're pretty excited about for businesses, and there'll be more to say about that in the near future.
Be on the lookout. Carlos, a new client.
I'm just going to make a prediction based on what I'm seeing in the market. Within the next 6 months, you're going to see one of the major, very, very well-known fund managers that is going to tokenize a fund for the first time. Not like there's been a lot of long tail stuff or a lot of like blockchain companies that obviously, are early adopters. No, we're going to talk about like somebody traditional from capital markets that is going to recognize the power of this and is going to, tokenize a fund or a portion of a fund to basically open it up to.
I can fully agree with that.
A little vague, but I'm getting goosebumps. All right, Steven, what do you got?
I think from our perspective, we see momentum in the market building. We've had 16 projects or tokens deploy in the last week. And we have of stuff we know of, which we don't know everything. We see about one a day deploying. Exodus Wallet deployed their Reg A Plus security token yesterday, and we've got about one a day at least through the end of August. So stay tuned. But I think it's an exciting time out there right now.
Yeah, on my side, one of the things that I'm really excited about is when people think of crypto, I think the first instinct is to say that crypto is going to somehow replace the traditional financial system. I don't believe that. I believe that the point of crypto is to bring competition to the traditional financial system so that we actually get better outcomes. And one of the things that is happening is, and I'll give you concrete examples, but one of the things that's happening is that people are realizing that they can actually use crypto to make certain portions of the traditional financial system more efficient without actually pricing the whole thing. I think one easy example is we have a partnership with Visa. Visa uses Anchorage so that they can actually have card issuers settle directly with USDC and with other stable coins without ever having to talk to a banking issuer and having US dollars sitting on a bank account. That's a perfect example of they're not replacing the payments rails, they're not replacing the credit card system, they're just replacing this one particular inefficient portion of it and creating way better advantages for both Visa and obviously the actual issuers. And this is a great example of crypto solving problems in the traditional financial system and replacing each piece at a time. So I'm seeing a lot of fintechs come to Anchorage that are looking at things that are similar. So we've talked about lending, we've talked about DeFi, all those things are happening and we're supporting these use cases. But I think the ones that are most fringe and that are the most interesting are where the companies are looking at their core business. They're looking at the core business and they're not saying, I'm going to replace this with crypto. They're saying, where can crypto actually fit in? And that ethos wasn't really there a couple of years ago, but all the building blocks are in place for them to actually go and be efficient about solving this particular aspect. So many fintechs with hundreds of millions of consumers are actually looking at this and replacing portions of their infrastructure. And that's really exciting because they're bringing their innovation and using these tools that we're giving them in crypto to say, actually, that's perfect for this, and that's perfect for this other thing. So that's pretty exciting for me.
I don't know about you, but I'm fully hyped. Hopefully you're convinced. Araby over there, he's got a tossable mic, so it could hit you in the face. Look out for it. Raise your hand if you want to talk.
Somebody want to...
Anyone have a question for any of these wonderful panelists? You just can't ask me one.
Right here. Yeah, I'll get it going. So how do you see traditional financial service firms fighting back? Why have they been so slow to the game? And how do you see it playing out?
I'll take a crack at part of that. I mean, look, first of all, traditional financial services firms are extraordinarily risk averse. And we've talked about how there's these licenses and regulatory clarity and we've got these things, et cetera. To the typical financial services firm, this is like red alert, risk all over it. I'm not going to touch this. Too much uncertainty. I can't do this. And there's just a huge amount of and frankly regulatory / risk inertia that exists that makes it very, very difficult to do anything. Now, it gradually changes, right? I think the other piece is just simply that why didn't Time Warner build Netflix or Facebook or Google? Why didn't Microsoft build Google Apps? Why didn't all these established media firms, communications firms, software industry firms, why didn't they do what was obviously going to be better by building on the open internet? Because they're so structurally limited in how they can do that. Their fundamental margin structure, profit structure, revenue structure, product structure is just different. And so I think you're just going to see internet native financial services companies build up to scale. And that's not to say that existing financial services firms aren't also going to come over to this, just like you can go to NewYorkTimes.com or NYTimes.com and you can get the New York Times. Their business model changed radically. You still have an AT&T account, but it's mostly for data. You're not using it for your video calls, which they envisioned would be a service that they would provide. You're doing that for free on the internet. So I think the model shift and major players absolutely will make that migration, but I just think that open source innovation, open internet models like public blockchains, internet native, software powered, financial services firms that are built on this infrastructure are just going to move at a much faster pace and velocity and are paving the way on risk and regulatory as opposed to waiting around for it to all be solved. And so I think that's sort of the structural thing that exists here, and why I'm obviously so optimistic about why firms in this space can build very large and enduring businesses.
I work at a telco, and I can tell you, worked for many years at a very high executive position in a Fortune 500, a large one. I can tell you, they didn't see WhatsApp coming, and they were convinced people will use SMS because it was a better way to do it, because all the phones support SMS, and there will always be this compatibility, and it's and the network, and the telco guarantees the delivery, and the other thing is not, and you have to install an app, and the app updates, and nobody uses SMS anymore. It's just died. So incumbents in industries, they're never the ones innovating, never. There's a book from Clayton Christensen called The Innovator's Dilemma that it describes this very well in like 20 different industries. And as Jeremy said, this never happened. My concern is not, a bank. My concern is the other competitors in the space, the other startups that are agile and fast and, take risks and innovate. So.
I would also just jump in and say, absolutely, Christensen is shadows of Innovator's Dilemma all over it. Is why should you support the thing that you're afraid that is going to make you irrelevant? It's very hard to overcome the dynamic because you have to be all in. But the second thing that I would say is that an exponential curve does not look exponential early on. And so you're looking at it, and it's very easy for you to dismiss it until it's too late because it's exponential. And so when you see it, it's already gone. And so you're already lost. So that's very hard. And it's hard for all of us, honestly, as investors in technology.
I'll speak into it. Sorry. So you all talked a little bit about the regulatory infrastructure and how that may cause some fears or just doubts about what may come next. I wanted to quickly ask Jeremy, you've been basically stamped by the New York Department of Financial Services. You've got that for a while now. For Circle and Center, where your collaboration with Coinbase, correct? I'm curious, you've already had USDC existing as an ERC20, and as well now you've integrated with Algorand. So I'm curious, what goes into that decision-making process, and what does it actually look like for you guys to integrate, and are you thinking about regulatory concerns as you're doing things like that?
Yeah, sure. I'll give a quick answer on that. So, we think about USDC as a protocol, just like HTTP is a protocol that sits on top of any operating system, any device, any browser. It's not like the web isn't tied to Windows or the Mac or a mobile phone or a server. It's just a protocol that you can interact with. We think about the need for that protocol to work on the leading internet operating systems for financial infrastructure, which are blockchains. And there's a lot of competition in blockchains. It's a wonderful thing. There's a huge amount of innovation that's happening. There are many public chain infrastructures that are getting traction in different spaces. And so our view is that your digital dollars should be cross-platform, just like your digital music or your digital content or your software or what have you. And so we came up with an approach to work with public chains on implementing USDC. Algorand was actually the first new chain after Ethereum that we launched last year. There are others like Solana and Stellar, and you can expect to see USDC on many more chains over time. And there's a lot that's involved in that, just in terms of infrastructure and security and various types of approvals, and then actually implementing it in Circle's infrastructure so that it can be a seamless experience for people that want to move from existing financial rails into that and move across chains in a seamless way. So there's a lot that goes into that, but I think this is something that, again, regulators, to your question, right? They have to understand that these kinds of financial assets and models are going to be taking advantage of a continuous stream of technical innovation. Like people talk about CBDCs, and maybe IBM's going to do a project with the government to do a one-off digital, whatever you call it, digital distributed ledger. I don't know what they call it in that world, but they call it something else besides blockchain and crypto. But they're going to implement something. It's this one-off thing, this permissioned infrastructure, et cetera. The pace of innovation is just moving so much faster. And so what happens with digital currency and dollar digital currency and these models is just going to need to keep up with that. And so regulators need to understand that this is just like the web. Like it didn't sit static in 1995. That's the web. It's constantly improving the protocol, constantly improving the infrastructure. And that's going to be the case in this realm of digital currency as well.
Hi, I'm Mark Powers. I'm teaching a blockchain law class at Florida International University. So this is my question. We talked about regulators, so let's focus on the SEC and OCC. If you had to pick one rule or regulation that you would want either one of those agencies to do for you, for the industry, what would it be?
I wouldn't actually pick a rule. What I will pick is that they move a bit faster. Because, we can work with the existing rules. Of course, some can be changed or not, etc. But every time we tell them we want to change this because we want to change our license to be able to do a little bit more here, a little bit more there, it takes forever. And that's the problem. That slows down innovation because, as Jeremy said, technology moves at a different pace. So if I had to ask them only one thing, is that they are a bit faster taking decisions.
Yeah, I think clarity would be welcome for everybody. And I think projects in general across the spectrum, including, I'm sure, everyone here, has had to spend a lot of time and money and energy thinking about how to navigate regulatory waters. So I agree for sure.
I would just say maybe take like a different position, which is I actually have a lot of empathy for the regulators now. Now that I've seen the other side very, very deeply, and it's a really hard job. And there's basically nothing that you get for doing the right thing and actually making the right call. And you'll get really bad stuff if you make the wrong call. So the incentives are really misaligned for you to actually be making risky bets on the space. And the second thing that I would say is that all my interactions with regulators, candidly, have been incredibly, incredibly collaborative. And that was, starting Anchorage, not what I expected. I was coming into as kind of like, oh, this is going to be friction, it's going to be a fight. And it's not. It's really, yes, it's slow moving. Yes, it's a process. We kind of understand all the barriers that are there. The system is fragmented. People don't really know if something falls under our umbrella. I mean, we're regulated not by just the SEC and the OCC. I mean, there's many state regulators. There's so many regulators, candidly. At one point, we have to think about probably about 9, 11 different regulators in just one initial jurisdiction. So I take the other position, which is, they've actually done really, really great stuff, and it's not at the rate that we would have loved or that startups move. But I have a lot of empathy, and they're actually kind of like very interested. The people there, the careerists, the people that are there, they love this. They love having companies come in and explain what they're doing, and like, here, Algorand, and why this is better, and what is the staking thing, and what is this AMM, and all of these things. They love hearing about it. It's just obviously like hard for them because the incentives are not aligned for them to be risky.
We got time for one more, and that's it. Who's got the lucky question?
I got two, actually. So
look at that.
What is the benefit of USDC over USDT, and what differentiates Algorand from Cardano?
I'll take the USDC question.
Let's see what happens.
Let's do it. That would be funny.
I mean, look, I think I don't like to specifically call out competition or talk about competition. I like to talk about what we're doing and why we think it's something that people would value. I think we've taken an approach of building something as a public standard. We've taken an approach to build something that operates under a clear set of regulatory rules. We've worked with regulators from day one. We've taken an approach to provide an enormous amount of transparency around both the examination and supervision of what we do, as well as the fiduciary sides of what we're responsible for. We've tried to build something that has broad kind of ecosystem involvement and participation. All of those things have contributed to the success of USDC. It's the fastest growing dollar digital currency in the world. It's taking market share from everyone, and that's a statement. I think that's a testament to the approach that we've taken. We also think that, per the example that Diego gave, a Visa that's integrating a digital currency into its core settlement infrastructure to move between issuers and themselves, and ultimately that whole value infrastructure, or a financial institution that's issuing a tokenized fund, or a bank that is going to put capital into an interest rate market on the internet, they're going to do that with a clear, open, transparent, regulated, well-run stablecoin. They're not going to do it with something that is not those attributes.
Trust me, if you're going to submit to the SEC your license saying, I want to use stablecoins, you will not put USDT, you will put USDC. Because if you put the other one, it's going to be like a shitstorm of questions or saying.
He's been rubber stamped, remember?
I know, because we have that problem. So.
We should have switched, Jeremy. No. I think it's a good question. I think there's obviously similarity in, to some extent, because Cardano and Algorand are both proof of stake protocols. Obviously Charles is a very early person and one of the people who's helped kickstart this market. So I think he's a great guy. Just speaking for Algorand, I think we've focused one on delivering just the foundational bandwidth and layer one technology that people need, and I also think when we look to partners like Anchorage, Securitize, USDC, having those all in chain is really important. Additionally, thinking about how you construct a layer one and how you construct features in layer one that enable people to deploy assets, transact in those assets, and ultimately create applications around those assets safely and securely is something that's very important. It's also why we have smart contracts in layer one as well, because everything is about safety, security, and scalability. And so I think that's reflected in the momentum that we have in the market. There's about 11 million wallets on Algorand today. It's growing very quickly. We have one of the handful of busiest blockchains in terms of daily transactional volume, and we've got over 4.5 million NFTs that have deployed so far. So I think what we're seeing is the market responding favorably to the approach that we have, and I think we're going to continue to just focus on deploying kind of technology that meets the needs of developers. And I think just last point on this, to some of the other things we've seen, is that there's a difference between capital and the applications that capital operates on, whether it's the form of security or money. We want to see both great crypto native, internet native applications deploying on chain, but also want to be a place where people can come and deploy their assets. And so that's what we're going to keep doing.
I will just add something. For what we do, it will be impossible to do it in Cardano. Like 90% of the functionality required to do anything basic doesn't even exist. So it's not, it might get there. I respect the people working there, but it's just not there yet in terms of basic things like issue tokens with the smart contracts, control compliance rules on chain in a decentralized way, and all that stuff that we can do in Algorand and on Ethereum and other more mature blockchains. So it's not even something we can touch at the moment.
Unfortunately, that is all the time that we have. Diogo has to hop on a jet ski and get to a yacht here. So let's all thank everyone. A huge round of applause to Jeremy, Carlos, Steven, and Diogo. Wonderful time. Thank you to Securitize.
Thanks for coming.